Welcome, 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 everyone. So excited to have you here. Glad you're here to experience with us the Tulsa 5 portfolio. Couple of housekeeping items. If you have any questions, please put them in the Q&A box down there on the bottom. Someone will be there to answer your questions. We will answer every single Q&A at the end of the session. So let me introduce ourselves. We are the Gold Bar Partners. We focus on the acquisition and management of value-add multifamily apartment complexes. Our goal is to create long-lasting relationships, not just to be a partner for our deal, but to create relationships that last. With our partners, Resilience Equity, we have over 50 years of combined experience in real estate, investing in over 8,000 multifamily apartments. We are very passionate in what we do, and we enjoy partnering with novice as well as seasoned investors. We have today a 5-property portfolio totaling 279 apartment units in Tulsa, Oklahoma, that has a ton of upside potential. This property is currently classified as 506B, which means that accredited as well as sophisticated investors can participate for a limited time only. June 2nd, that window closes. Yes, this Friday, that window does close permanently for our sophisticated investors, converting it to a 506C classification, which is then only open to accredited investors. Disclaimer here, this is just for educational information purposes only. This is a full disclaimer on the screen. We are not tax accountants or lawyers. We recommend that you thoroughly read what's on the screen in front of you and the investment documents, the actual PPM or the private placement memorandum offered at the end of this presentation when you sign up with the QR code on the investor portal. You'll also be able to make your commitments and fill out the subscription documents to secure ownership position. Please come evaluate a business partner relationship with us. We are not just here for a deal. We are here for you in the long run. So let's walk through what to expect tonight. I'll introduce you to the Tulsa 5 management team. Yannick will give you the reasons why we are excited about this market as well as these properties. I'll get back with you all to go over what the excitement means for you in returns. Then you can all ask all your questions because I know I talk fast. Don't hesitate to start asking them now in that Q&A button down at the bottom. We will get to them at the end. So we know that having a strong management team is the most important factor in the success of a project. So let me introduce first the Gold Bar team. Cindy McGuire, she is our investor entrepreneur for over 25 years, acquiring real properties with value add in single family, multifamily, commercial, and hospitality. With a background in engineering and master's in business, her calculated and project management approach to each asset yields organized, process-driven solutions, which make potentially challenging properties even more exciting for the team. Yannick Matthews, my better half, based here out of Central Florida. He's our All-American kicker whose 20 years of sales management in B2C and B2B organizations is the deal dynamics that knows how to punt any negotiations, whether it's brokers or property managers, back to their end zone. And then you've got me today, Marichelle Matthews. I manage all of the strategic partnerships for Gold Bar. My background is in corporate client management and Fortune 500 C-suite relationships, which enables our team to evaluate the enterprise level operations, or as I like to say, raise the gold bar. Now, on the other half of the screen, you'll see our sponsors and key principles. What we do know in this space is that experience matters. And in multifamily, there's no doubt that experience really does matter. This team shows over ownership interest in 8,000 multifamily units, currently over 7,500 managed, 50 plus years of combined experience in all different kinds of real estate investing, 2 property management companies built from the ground up, extensive asset management with construction management experience. Thanks to all of this experience that this team has seen and endured, it becomes a value-add advantage for all partners. Now we have the experience and we have the opportunity. A strong operating team is definitely what matters.
Absolutely. Thank you, Marichelle. Look, in addition to a strong operating team, guys, market selection is equally important, right? So we focus on opportunities in emerging markets where local economies are expanding, much like the Tulsa market. Expanding economies equals more employment opportunities and an increase in net migration. This ultimately sums up to a strong, robust tenant base, and it's critical. It is absolutely critical to our investment strategy to be extremely diligent in choosing a target market, because it helps us do a couple of different things, right? It helps us identify undervalued multifamily properties for acquisition, value optimizations, as well as management and disposition opportunities, a little bit more than a couple. So we characterize emerging markets primarily by analyzing local economic reports, population and job growth, rent and property value trends, and also path to progress indicators like major redevelopment and planning that impacts the livability of the surrounding community and the value of the property. Right? We do this by leveraging four economic drivers. One is government, economy, technology, and then societal factors as well. You know, the local government in Tulsa is dedicated to attracting jobs, and we absolutely love that, right? They've implemented several pro-business policies and regulations, including incentives for companies that invest in the local economy. They've committed over $510 million in economic development projects, and they're rated right now number 3 out of the top 10 metros via Freddie Mac for 2023. All right, they've also have earned a top tier designation as one of the best cities for startups. And this is, obviously we love to see these kind of things, right? It lets us know that, yes, Tulsa is on the move. As a result of these very key things, the economy is strengthening, right? What we are so excited to kind of announce and to talk about today is that that Tulsa's just been awarded a federal grant for Building Back Better. It's an American Rescue Plan, and they've been granted $38.2 million. The funds are going to be used by, a coalition of organizations, including to create the Tulsa Regional Advanced Mobility Corridor. It's anticipated to generate anywhere from 30 to 40,000 jobs, okay? And it's an equivalent of $3.5 to $5 billion in economic activity over the first 2 to 3 years, right? I mean, goodness, like that for us is just huge. Not to mention Amazon, they just went ahead and they built 2 to 6 million square foot facility there in Tulsa. If I'm not mistaken, that's already underway. I think that's already also built. And then we have Canoe Electric Car Company. Like Tulsa is attracting businesses. They're attracting more folks to the economy and to the actual area because of these opportunities that they're providing. 2,000 jobs from Canoe. It's an electric car company. Not the most beautiful cars, but hey, look, people are moving towards a cleaner kind of environment. And these cars are definitely, like Tesla, making a big impact. So, we love everything that's happening. Technology-wise, Tulsa is also, or they've always been known really for oil and gas. The city's coined a different slogan for the future, though. Right? This is aligning with everything we've been talking about, a new kind of energy, right? It's an intentional move towards a technology-centric economy, investing in parks, educational programs, even incentives for remote workers to relocate to Tulsa and attract talent and promote its technology sector with the Tulsa Remote Program, right? So look, we have a supportive, dedicated government committed to growth. We have positive trending economy focused on technology and innovation, and all the while being 11% more affordable a city to live in than the national average, right? There's also a strong focus on education here. There's 86 public schools serving 35,000 students in Tulsa, 15 colleges and universities to choose from for higher education, such as Tulsa University and Oklahoma State University. And guys, the demographics are strong as well, right? Steady population growth forecasted over the next 5 years. Household income projected an increase of 2.5% over the next 5 years. And then median household income and home values projected to increase over the next 5 years as well. These are factors that scream emerging market to us. And as I mentioned, you have $510 million in economic development projects that are complete game changers. Like 300 million funded expansion of the Port of Catoosa. This port connects Tulsa to the Mississippi River and the Gulf of Mexico, making it more of a competitive and attractive environment for industries that are looking to access national and international markets. You have 25 million to preserve Route 66, as Cindy loves to say, get your kicks on Route 66 and celebrate the history and the culture of the iconic roadway, helping to generate more tourism while spurring economic growth and development to the region. $60 million investment into the Noma Market District with a mixed-use development of retail, commercial space, and residential. The reason why this northern Tulsa or this Noma Market project, which is in northern Tulsa, is such a historically big deal is because this area has been very much underserved in the Tulsa area, very much marginalized in the city's development efforts in the past. So this is a very intentional move by the city, letting everyone know that, guess what, guys, no one's being left behind. And we love that story. We love that narrative. And I'm sure every single person on this call wants to be a part of that growth as well. So Tulsa's checking all the boxes for us, right? You got the local government, they dedicated to attracting jobs. Jobs are being created rather than lost. People are moving in rather than leaving the area, and rents and property values are rising. Tulsa is raising the bar. I know that you love the market so far, guys. I'm going to talk a little bit about the properties. I know you're going to love these as well. So the Tulsa 5 investment opportunity is a portfolio of 5 apartment complexes consisting of 279 units total. We have Covenant on Memorial with 93 units. We have Bradford Townhomes with 62, Delaware Gardens with 30. We have Melrose with 54 and Silverwood with 40. So Tulsa is a steady growth market, okay? High demand for rental units. Therefore, accumulatively, the portfolio is achieving 94.3% occupancy, guys. Now, just think about that, right? We have 5 properties that accumulatively, they are achieving 94.3% occupancy, which means that, you know, before purchase, the property is already stable and positively cash flowing, right? That's a game changer for us, right? So it gets better. The total loan amount is for $14,045,000. Each property in the portfolio comes with a 3.6% fixed rate assumable loan average, okay? That lasts until 2031. So think about that, right? Like if we were to try and purchase these properties just regular, how we would try to purchase it at any other time, it would be about 6%. So just think about how, you know, how big that is, right? 3.6% fixed rate assumable loan average over the next until 2031. Big, which lets us know that we have more than enough time to, you know, obviously execute our business plan. And then upon selling or exiting the property, we have the ability to pass on that 3.65% average to the next buyer. Beautiful, right? We target properties of the similar vintage, 70s to 90s. These properties fit perfectly within our value add strategy because they provide the best opportunities to purchase at a reasonably below market rent price due to outdated amenities. If you don't know already, multifamily properties are primarily valued based off of rental income. Okay, let me say that again. Multifamily properties are primarily valued based off of rental income. So it doesn't matter if there's a property that's across the street that has been sold for $10 million below the price that we have this property for, right? It's based off of the amount that the property generates in income. It's a true business. So we purchase at a sweet spot, renovating and updating, upgrading these properties, bring them up to market standard and ultimately unit pricing. This is a process that we as a deal team are absolute experts at. In a nutshell, we purchase low, upgrade amenities, allowing us to attract better tenants, increase rental rates to market standard, which leads us to higher returns for our investors. With average rent today just under $200 across all properties, we are absolutely confident in our business plan to capture market rent in time for when we're ready to exit, maximizing their value. Our advantage is the economies of scale of having 5 properties. This reduces the cost of professional property management staff and materials needed for upgrades. This gives tenants different building types also, and unit sizes and locations to choose from within the market, making us appealing to many different tenants' housing needs. So if you have, let's say, someone who's in a 1-bedroom and they need, a 2 or 3 bedroom, they have properties that we have options for them, right? In the properties that we have available. Or if someone needs to downgrade, we have those properties as well. Going from a 2 to a 1, maybe they lost a roommate. We have those opportunities. So we're making sure that we're being on top of that leakage. In addition to that, we're not reliant on the success of just one property. This diversification helps reduce risk for our investors, creating a more stable investment. Let's take a deeper dive into the business plan. Curb appeal helps attract new tenants and keeps existing tenants satisfied. Right, creating a more welcoming exterior landscape, it's going to begin with some of these exterior upgrades. So we're going to focus on balcony repairs like wood rot or any structural needs that's common for these vintage kind of properties. Ensure that the property is structurally safe, compliant with code and regulation, but we also want to make sure that it's beautifying it as well. Making sure we have sufficient lighting, making the properties lighter and brighter, landscaping, signage, refreshing exteriors with power washing and light paint where needed, okay? Interior upgrades, we're gonna be doing some rehabbing to the front office, right, to create that first good impression for new tenants, that's key. Any kind of kitchen upgrades, replacing countertops, cabinets, appliances with modern finishes and functionality. Bathroom upgrades such as vanities and fixtures, bringing them up to market standard. We break down our business plan into 3 different phases. And phase 1 is kind of our top priority, right? Is firstly establishing strong relationships with tenants during the takeover process. We'll do that by personally reaching out to each one of them, informing them of new management, attack any pending work orders, showing good faith and prioritization of their needs. Building meaningful trust, make an immediate impact on their living with the improvements to the property's exterior and create excitement around what's going on right on the property. The new manager, we want them to be excited about it. And that's key for us. Then we'll start to set proper expectations during phase 2. We'll start to evict the slow, non-paying and troubled tenants, or every property has those, and implement collection and screening policies, evaluate our tenant base to keep good tenants, and contact tenants whose leases are expiring in 90 days and mitigating that risk to losing them. We also want to prepare to make units ready, okay? Reducing turn time and capturing market rents for the new incoming tenants as soon as possible. And lastly, what we want to do, phase 3 is start upgrading amenities, repositioning interior premium units and hosting community events, adding additional income streams and getting ready for the exit. Now, we feel really comfortable and confident in our property management company. And so, we've partnered with the number 3 largest property management company in the US. Their name is Asset Living. They're currently in 43 states with over 5,700 employees. They have a proven track record of managing over, 75,000 units and achieving 95% average occupancy rate. So we are confident in the ability to successfully manage the portfolio and execute a smooth takeover process. And look, we are fortunate and excited to work with them as well, with their experience and expertise. So, these are the properties. This is our business plan. We're excited to get started, ready to execute. Now that you guys have seen the properties, you've seen the market, Marichelle, my better half, is going to talk a little bit about the numbers. What we all love is the numbers.
Thanks, Yannick. Creating a home for our tenants and building a community is part of the reason why we do this. We also love to do this to create a community of investors who understand the value of investing in multifamily apartments, making a difference in their future as well. Multifamily real estate investment has outperformed the S&P 500 for decades, not only for big corporations, but investors like you. So what we'll do is we'll kind of break down, and this slide will show you how and where the money is coming from and what it's going to be used for. So we're actually going to be acquiring the assets for about 19 million. We've baked in just another 325,000 in closing costs. We budgeted just under a 2.3 million in capital expense reserves, about another 140,000 to assume those low interest loans, few hundred thousand in reserves and startup fees for a total acquisition and construction cost of 22,127,315. Baked in is another just over 500,000 for sponsorship fees, combining the acquisition fee as well as the underwriting and due diligence fees, which is split up amongst the management team for acquiring the deal, all the tasks and items, bringing it to closing, and then of course managing the asset for the full 5 years. So the total sources as well as the total uses will equal 22,665,417. Now, what you do see on your screen here is the 5-year pro forma breakdown. A lot of details here, guys, but you can go ahead and comb through that once you download a copy of the actual deck that will be inside our portal. So go ahead and sign up and start looking at some of that information now. What I do want to share is that we do underwrite very conservatively to keep your money safe, our tenants safe, and give ourselves an opportunity to over deliver for you. When I say we underwrite conservatively, we actually account for about 2 to 3% rent growth year over year, although some of these markets have seen double-digit rent growth, especially over the last few years. What I do want to point out here in the middle of the slide is the net operating income. Year one, we will be, just over the $1.1 million mark, so $1,032,937. This is how value is determined, and increasing it is how value is actually created in multifamily. So delivering on the business plan that Yannick touched on will allow us to increase the rents that will drive that NOI, that net operating income year over year, to a conservative $1,805,435, allowing for a profitable exit. So you can also see, if you kind of scroll down to the bottom of the page, that cash on cash on the bottom there, that's where the preferred returns that investors like you will be receiving in cash flow. So let's break down that cash flow right now. Investors are paid 2 ways. 1, by cash flow during that 4 to 5 year hold time, and 2, by proceeds to equity at resale. So this investment is available for accredited as well as non-accredited investors. The minimum investment is $50,000. Preferred returns is paid to investors first before anybody else. That 7% is distributed quarterly, years 2 through 5. The returns are delayed during that stabilization period and caught up as soon as possible during the whole time, and at latest it would be at resale. So as a sample investment, let's just say you invest $100,000. With our conservative projections, with the cash flow and equity gains, we project you will turn that into $206,000. Firstly, by $35,000 in combined cash flow over the 5 years, plus the projected $71,000 proceed from equity growth. Now, we've actually modeled this deal at 5 years, but we're always evaluating the market and where we are at. So if the numbers make sense and we are already at 5-year projections, for example, month 1 of year 4, we'll take into consideration exiting early to be able to get you guys your returns as soon as possible. Now, as investors, we invest for monetary returns, but as real estate investors, we love not only the dollar upside, but also the tax benefits. Again, We're not accountants or tax professionals, but just like having a retirement plan, having a strong investment strategy includes a strategic tax strategy. So for the Tulsa 5, we'll actually be ordering a cost segregation study. So that's when a third-party engineering company comes in, and after the cost basis for the land is removed, they'll itemize what parts of the property we will depreciate and can be accelerated upfront. That amount will be shared down to investors on your K1 statements next year. Although it's not an exact amount, we estimate it could range 20 to 30% cost segregation, which, for example, an investor investing 100,000 could be looking at 20 to 30,000 or more in tax relief for 2023. Now, a lot of our investors currently who work and do well professionally would rather invest their money and have it grow and work for them and offset that tax burden rather than just give it to the government. Uncle Sam rewards us for investing in real estate, and that's golden. What you see everybody on the screen is the ownership structure. I think this is really important to understand how a syndication, a multifamily syndication actually works. So the ownership is what we call a 70-30 split. So the managing team will create their own manager LLC, and they'll be the managing partners or the GP, the general partnership. They take 30% ownership into the actual asset or the building property. And that what they bring to the table would be the sponsoring management, which offers not only their liquidity, but as well as their experience, as well as guaranteeing the actual $14 million assumable loans. So that high net worth, this team will also be the ones that raise the money to be able to fund the deal and find the right investors to partner with. They're also the team that finds the deal, underwrites it, and does whatever it takes to get it to closing. So now the other 70%, which are the limited liability partners, they're the investors like yourself. We call them LPs because what they do bring is the equity. But unlike the managing partnership, you don't have to deal with the day-to-day operations for the property during that 4 to 5 year hold. So just a quick recap about the Tulsa 5 portfolio. Purchase price on this portfolio is $19 million. With an equity raise of $9 million. The ARR is, well, actually the equity raise, because we've actually already done the due diligence on here and we were able to fine tune the business plan on it. The equity raise is under $9 million now. The average annual return is now at 20.65% with a preferred return of 7%. The minimum investment is $50,000. We anticipate to hold this period about 4 to 5 years. It is currently today open for sophisticated and accredited investors, and we'll be converting it to a 506C offering on June 2nd, which is this Friday. Now, this investment is for those who are looking to scale up from single family properties to multifamily. I mean, with us facing a recession and the fear of unstable markets, interest rising and home prices drop, and the equity you thought you had in it lost because it's its natural appreciation. Multifamily is what we like to say recession, but we do have a strategy and the systems like this in place to force the appreciation. So we say that multifamily does perform very well during recession markets. If you're also an investor who's just looking to diversify your investment portfolio with real estate, this is a great opportunity for you. Investors also that are looking to grow their retirement fund. If you've looked at your retirement fund lately, I'm sure you've noticed 20 to 30% loss or more. Let's face it, the market corrects itself at every 10 years by 30 to 40%. So if you like that Warren Buffett method to set it and forget it, that's fine. Because 40 years from now, yes, the market should be up by the time you retire, but you lost 30 to 40% of your investment 4 times. That means you gained and lost again and again. I mean, are you done losing yet? Let's stop going backwards because we're not getting any younger. Or maybe you're just someone that has money sitting in the bank doing nothing or making less than 1% a year. Why not make your money grow for you passively? Yes, that means you make more money in your sleep. Now that you've seen us, you've seen this deal, now let's see you guys take action. On the screen, you'll see the timeline. Our subscription documents are currently available on the portal. Please use the QR code on your screen or the link that's in the chat. Funds are due for non-accredited investors or sophisticated investors by June 2nd. Our anticipated closing is still scheduled for June 15th. Currently, it is open for sophisticated and accredited investors, but this Friday, that window will be closed for sophisticated and only open to non-accredited investors after June 5th. We will be converting it to that 506C offering. We will have a limited time and a limited number of spaces for the sophisticated investors. So the investments is on a first come, first serve basis. Raise the gold bar, guys, and invest with us.